Welcome, Insignio family. Today's Friday, December 20th. We are joined by a very special guest. With us today, we've got Mark Lacey, Head of Thematic Equities at Schroders. Mark has held several roles over the last 28 years within the resources and energy space, Credit Suisse, Goldman Sachs, and Investec, to name a few. He's responsible for the global energy transition, as well as the food and water strategies. Mark, welcome.
Hi, Alejandro. Thank you for your time today. Thank you, everyone else.
Absolutely welcome. So, team, we've got 30 minutes to unpack a wide array of investment topics. So let's get right to it. Mark, in your overseeing of thematic equities, what are you seeing as the most interesting opportunity set?
Yeah, we should just go straight to the most obvious slide. Why don't we go to page 18? And I would say there's a disconnect finally in the market. I'll go through the reasons for this disconnect. But on page 18, you can see basically the range of thematic funds that we manage in Schroders. And at the moment, that the energy transition fund looks like a value multiple relative to its growth. Manat, please, could you go to page 18? I don't know if you've done it or not, but my screen might be delayed.
Yes, you should have a slide called Thematic Fund Characteristics in front of you. That's what I'm sharing.
It hasn't updated. Okay, not to worry. I'll just describe the fund. This is a great start, but basically, at the moment, the energy transition equities are trading at a deep discount relative to our tech funds in the thematic range. They're effectively trading at value multiples of around about 7 times versus tech funds, which are trading closer to 20 times. If we go back one slide as well, and we basically go to slide 20, actually. When you look at the energy market right now, it effectively is very, very out of favor. I'm going to refer to page 20, but I know you can't see it on the screen, so apologies. But basically, energy as a weight in the market now is its lowest level, again, for about 4 decades. So energy weight within the index typically trades in a range, or has a weight in the range of around 4% all the way up to 14%. At this point in time, it's below 4% in the market. As you know, that there is a huge tech bias in the market. So this is the time to buy energy exposure. And the reason why it's definitely the time to buy energy exposure is because you typically buy or take energy exposure as a diversifier, basically when the market is obviously very, very concentrated, which is what we have now. But when you look at the fundamentals for energy, they're overwhelmingly positive. Alejandro, can you see the updated slide at all?
On my side, I can't see the updated slides, but
No, I can't either. So
On my side, it has changed. I can try and stop sharing and then reshare. Give me a moment.
if you could please do that, that's appreciated. Thanks, man.
And Mark, so there's a concept of energy transition and things that are very important for the world, right? But does that necessarily mean that it is a good investment case?
Yeah, so when you look at the investment returns of energy, it has to be in what's called effectively a net investment period. So when the market's consolidating and investment's falling, that's a terrible time to own energy. When you've got basically a net investment period, i.e. huge amount of capacity needs to be put in place for energy, that's a really, really good time to invest. So if we go to page 10, please, let's see if this works now, Manat, because we can see the slides now.
Yeah.
Yeah, that's great. And what you can see on page 10, Alejandro, is right in the middle, is that's actually what's happening with power markets. And I know you use the term energy, because when you look at oil demand growth is really, really limited. But what's transformational is power markets. Now, there's lots of different technologies that are going to grow that demand profile, which we see in the chart right in the middle here. But the big difference between now and the next 5, 10, 15 years is that you're going to see global electricity markets more than double just over a 16-year period. And I cannot tell you how big hyperscaler and data center power demand is. Nuclear is going to win in this. I don't think there's any question about that, but you have to be careful about duration of nuclear. First nuclear plants are not going to come until 2032. The other area which will win in this is gas, and gas usage is going to be transformational. I mean, just when you look at the US market, the last 20 years, electricity demand has been flat, basically flat for the last 20 years. When you look going forward for the next 5, 10, 15 years, you're growing electricity demand by around about 3 to 4% per annum. That includes areas like India, China, parts of Southern Africa, and Middle East, which are also massively growing their energy needs. Data usage is effectively transforming that power market. And what we basically have today is a market in energy transition. If we go back to page 18, please, Manat. We've seen our tech funds, so our robotics and automation fund, they've performed extremely strongly in the last 3 years. So the robotics and automation fund is up over 100%. It's been a very, very strong performer in 2024. But everyone knows this now in terms of what's being discounted in the equities is already high growth is being discounted. In the energy transition fund, really low growth is being discounted. You can see that disparity. And then global energy is a value fund. The way we manage those two funds separately is we have the transforming companies in global energy. That's also been a very strong performing fund over the last 3 years. And then the energy transition fund. The energy transition fund is pure play, but it is really, really out of favor. And I can illustrate this well when we basically turn to page 26. And you can see on these on the left-hand side, this really sums up where the market is on this sector. Though that is net flows. So Alejandro, the biggest problem facing the sector is that a lot of investors have thrown in the towel on the energy transition and renewable energy funds. You know, our fund was up 120% over a year period in 2020. We went to 20% cash, which is the maximum cash position. Our global energy fund was fully invested over the same period, but it still hasn't stopped the fund drawing down, considerably outperforming the benchmark, but drawing. What we see, and you can see this size of passives as well, we're starting to see those flows finally subdue. And where we are now from a valuation perspective, if you go to the next slide, you can see from a valuation perspective that the sector is now heavily discounted, but expectations are really, really low. And these investment rates are picking up. So what I won't do today is go into the individual markets. There's a separate presentation that Alejandro has that he's more than happy for you to have a look through that presentation. It has a 4-page summary on each market, whether it's batteries, wind, solar, renewable generation. All of these markets are growing. All of these markets are growing significantly, and the earnings are growing. And the reason why we're so vocal today to our investors is today you don't overpay for this exposure. In 2020, Shaq O'Neal, the basketball player, launched his own SPAC and raised 350 million. When that happens, it's an investment bubble. You know you're in a bubble when a basketball player is suddenly becoming an expert on clean energy tech. Where we are today is basically these renewable assets are trading at a deep discount to conventional. And so the most interesting thing about running a hybrid energy mandate, which we do for one of our clients, is if we go to slide 21, please, Manat. What you find is when conventional energy is outperforming, energy transition equities are underperforming, and vice versa. In fact, if you look at that monthly dispersion of returns, it's 10% per month is your average returns dispersion. So what we do for individual clients is we run what we call hybrid portfolios, and these are very bespoke portfolios. It's not a Luxembourg listed fund. We keep these as segregated mandates. We run a portfolio where we manage the weight of energy versus energy transition up and down. And therefore, as a result of that, we've captured additional alpha over and above the benchmark relative performance. Over time, I think the sectors will trade closer and closer together because the big oil companies are starting to move their portfolios. But we're talking over a long period of time here, and you have to get the oil fundamentals and the gas fundamentals. We are long natural gas in our conventional energy portfolio to be a significant beneficiary. Sorry, Alejandro, that was a bit of a long-winded answer.
It should be, because there's a lot to unpack here. One of my favorite slides on the chart is showing the classic bubble slide over the last 5 years, and reinforcing the timing of pounding the table here, because we are in that last phase, in that blow off phase after a pretty wild mania phase with renewables that we saw over the last few years. So given that, we are at a very interesting inflection point to be looking at things that have been out of value or out of favor. Mark, would you help us understand energy transition equities? Does that necessarily always mean renewables?
Yeah, that's a really good question. Absolutely not. So energy transition equities can span across quite a wide universe. And in fact, if you go to page 29, please, Manat, this gives you an idea of basically subsectors and nuances within energy transition. So you're absolutely right. Right in the middle there, Alejandro, you've got renewable generation. You have solar equipment, you've got wind equipment, but you also have electrical equipment, which can span, and transmission and distribution, which can span a huge amount of markets. Electrical equipment can be used for obviously electrical efficiency. The one area we don't invest in this fund, but we invest in obviously in our robotics and automation and our disruption fund, is semiconductors. And obviously that's part of semiconductors are part of the energy transition as well. So there are various different subsectors that we span across. Our universe is quite wide. It's about 350 companies now. What you'll notice from actually on the right-hand side is every single subsector, because of index selling, has compressed most subsectors. And this scatter chart on the right-hand side was very scattered if we go back around about 3 years ago, and now everything is compressed because everything in the index is down. Area with exposure in the hydrogen. I just want to reiterate, that is a story that was way overhyped in 2020, and we have no exposure in the portfolio to direct hydrogen, and we don't intend to. Green hydrogen is a post-2040 story.
Interesting. Now, headwinds for valuations, you touched on some of the flows data where we've just seen outright money leaving the space. So obviously a headwind. What other headwinds can you give us? Is it interest rates? Is it, earnings growth forecasts kind of being revised after being a little lofty over the last few years?
Yeah, two very good points there. Let me go through thing on interest rates first. I mean, the sector has had a huge amount of correlation with interest rates, and the access to debt in the sector is unbelievably binary. I'll give an example. There's some companies that are issuing debt at 14%. I don't know a single CEO that walks into the boardroom and says, hey guys, we're going to expand, and by the way, we're going to borrow at 14% and we're going to make money. That just doesn't happen. So when you issue debt at 14%, you're on your last legs of survival. And obviously we do not invest in those companies. In contrast, there are companies that are using this opportunity in the downturn to cut costs and be really well capitalized. One of our investments in the fund is basically Enphase. Enphase is pretty well known in the market in the microinverter space. They are literally buying back shares as fast as they possibly can right now. They have a net cash position of around about $800 million. The CEO has just announced a 17% cost reduction program. All of those cost reductions through the redundancies are basically going into a buyback program. So there's two contrasting types of companies in the market around debt, and no way are we banging the table and saying, well, let's hope interest rates come down and that makes the sector a buy. That's not the investment case here. It's the transfer of value into the areas which have already gone up on the back of the AI spend and the capital that's going into data center rollout, and it's that transfer of value to who benefits from the power build out over time. The second headwind, which I think we need clarity on, 116, and that's based on the Inflation Reduction Act. So the Inflation Reduction Act has been obviously a big stimulus for the sector. It was a stimulus when Biden got elected and the proposal for it was put forward. And now it's been a headwind because everyone believes the Inflation Reduction Act will be tweaked. And we believe it's going to be tweaked. Things like charging infrastructure, EV subsidies, consumer credits, effectively are likely to be removed, and they're likely to be voted through Congress. Not like, for example, the debt ceiling, which obviously didn't go through last night, where you've got a problem there, the government might stop. I think this will actually get voted through common sense. However, manufacturing tax credits are likely to basically be rolled over. And this is really important because the way the equities are trading is the Inflation Reduction Act is going to be blown up, and it won't be. It's going to be tweaked. And I'm happy to send some notes from political correspondents that we've basically been engaging with on this.
I've heard the nickname is the Inflation Perpetuation Act also in some.
Yes, yeah.
The oil market super cycles follow periods of underinvestment. Okay, and that's oil market. What's the relationship then to the renewable space? Because we've seen underinvestment across the board.
Yeah, it is all about basically earnings from here. So from here, obviously, this is a long cycle in energy transition investment, and it's a long sustained cycle. And just so everyone is aware in terms of scale of investment, Manat, if you could go to slide 11, please, just to start with. That the global oil and gas investment is currently running around about $800 billion per annum. As you can see, across those various parts of the energy transition space, renewable generation is now up to 600 billion per annum. Clean mobility is already up to 400 billion per annum. So it's already 3 times the size of basically conventional oil and gas. And it has to get to around about 4 times the size to meet any of the initial targets. But what is the main driver for this sector? Well, the depressing slide is on page 25. And this has to happen, Alejandro. This is what earnings have done on a 2-year forward basis relative to the market. So you'll see that actually what we've been suffering in the last 18 months is nothing but revisions down to 2-year forward earnings. If you're paying 12 times EBITDA for something, you have to grow earnings. Otherwise, you trade at a value multiple of 6 times. And so the earnings revisions have been down and down and down. And we're getting to the point now where earnings expectations are really, really low. So then what we did was we mapped out our expectations of earnings based on the lots of the company calls we have. And you look on page 31, we've got our EBITDA growth on the left-hand side. And in 2025, we think earnings should grow about 20% for the universe and over 25% in 2026. Basically, we think we've reached a point where the earnings expectations now for these companies is too low. When you look at growth on a go-forward basis, they can grow expectations. And this is the contrasting dynamic in the market with conventional oil at the moment, is we are underweight oil-exposed companies in our conventional fund because we think earnings expectations for the oil part of the market are too high because there's downside risk to oil in the short term. So it's understanding these earnings dynamics, which is what really gives us conviction on the energy transition side from here.
Mark, are there areas within the renewables space that you deem unattractive or unfeasible or just kind of like the dog of that area?
Yeah. Hydrogen, without a question.
Because of valuations or because of feasibility to provide? Feasibility.
So who's going to dominate hydrogen markets? It's going to be conventional oil and gas companies. You need to be able to produce hydrogen and hand really high volatile product. Most industries are not ready for hydrogen, and Aramco Saudi Aramco are probably going to dominate hydrogen markets at first through blue hydrogen, not green hydrogen. So hydrogen is an overhyped area and an area where there's lots of electrolyzer capacity. There's now 40 to 50 gigawatts of electrolyzer capacity that's been put in place globally. And the market size at the moment is around 4 to 5 gigawatts. So it's an area which is just massively oversupplied. And so that's one area. Charging infrastructure. Charging infrastructure is a hyped market as well. There's an element of people believing it's really sophisticated, but it's not. It's a guy with a screwdriver and a little wall box and saying, I'm a charging company. He's basically providing people with a DVD player. So these are the sorts of areas that we have to be really, really careful about and say, does this have a competitive edge? Is there a technical expertise attached to it? In contrast, we've got areas like renewable generation. Manat, if you can flick across to the other presentation, please. And if we can scroll down, please, to page 28. And thank you for controlling this. So look on the left-hand side, Alejandro, and this sums up markets for you really, really well. So on the left-hand side is a simple chart looking at conventional generation. So this is nuclear and gas versus renewable generation. Renewable generation went to 4 times price to book, overhyped relative to its returns, whereas conventional generation was trading in the doldrums at 1.5 times price to book. Conventional generation has almost doubled in terms of its valuation. Renewable generation is down 75% and is trading at 1 times book value. A lot of the companies are trading at replacement costs. So you and I, if we wanted to buy those assets or put those assets in the ground ourselves, we'd end up basically spending more than what these companies are trading at as a finished entity. So they are unbelievably cheap at this point in time. And that's the flip that's happened in the market. And that's why renewable generation looks very attractive. That's why 3 of the companies in our fund have been taken over by private companies. So KKR basically bought Encavis in our portfolio. Brookfield bought Neoen, and EQT Partners bought Ox2, all for 50% premiums, but we still think they've stolen the assets.
Wow. Okay. Let's look about one truth in the oil market that investors have wrong.
One thing they've got wrong, or you think there's a poor perception of?
Yeah, either a market perception where they're just completely off sides, where you know it, but they don't.
Okay, I'll give you the first one, which is a long-term one on page 2, which is basically the oil market, even regardless of what the IEA says, the oil market needs to grow to about 120 million barrels a day between now and 2030, just because of emerging market demand and just because of basically petrochemical demand. So petchems is the big part of the market, whereas electric vehicles, as you see on the left-hand side, substitutes gasoline, and that's just the dark green wedge at the top. That's the first misperception. For page 6.
That last sentence you cut out there, Mark.
Pardon?
Those last 2 sentences.
The second misconception is on page 6, which basically shows you where inventories are now, and everyone say, well, that's bullish for the oil market. Okay, so I've only done this for 28 years. You want to buy oil exposure when inventories are high, and you want to sell oil exposure when inventories are at rock bottom. And the reason being is, look on the right-hand side, look what inventories do towards the end of this quarter, and look what they do going into Q1. You're going to see big inventory builds. And that's going to put the oil price under pressure. So the oil inventories will go up, the oil price will come down, the oil price will come down, and that will mean that the producers start scaling back production. The third myth of the oil market is the US can just keep growing production forever, and that drill baby drill by President Trump will basically stimulate this huge growth in oil. It won't. The average reserve life for your E&P company in the US now is only 8 years. It's come down from 20 years around about 10 years ago. So that shows you how much they've overproduced, to only 8 years today. So there's 3 myths that hopefully provide a bit of balance to the oil market.
Huge. Thank you for that. Now, for those on the line, there's 2 funds. There's the transition energy fund, and then there's the traditional, more carbon intensive energy fund, which has been the outperformer because rising tide lifts all boats. In both of your funds, you guys have outperformed the benchmark quite nicely, right? This one market has seen, instead of a rising tide, a coming out of the tide. And so everything in that space has, gotten beaten up. Last week, we postured, who was excited about investing in a fund that was down 4 calendar years in a row, just single digits, but it's because the market as a whole has just been so out of favor. As we're going into the last 5 minutes here, Mark, some closing thoughts and tying these themes together.
Yeah. So the biggest perception at the market at the moment is obviously the world is going anti-renewables. So that you can see that from a political perspective. I mean, even the French energy minister didn't even bother turning up to COP29, and it's called the Paris Agreement for a reason. So basically, there is a perception that you just never need to invest in the renewable space again, which is just not true. In order to basically meet the power demands of data centers and growing power demand globally, you need to invest in renewables. Now, don't listen to me. Microsoft have basically enlisted Brookfield to build out their renewables portfolio. So Microsoft, the builder of the data centers, has basically said, we need renewables exposure, go and buy it for us. Now, the public market is trading at a deep discount to the private market. And we just think there's going to be lots of M&A in the public market as a result of private market coming after this. And so if we had $1 today, we'd put basically 70 cents of that dollar into renewables and 30% into our gas exposed energy fund. We have high conviction in our energy transition fund. If we go back 3 years ago, that dollar was flipped the other way around. So we're very, very comfortable with where we are at the end.
Awesome. Closing thoughts here on goals. Where do you see this in 5 years? What goals do you have for your fund? And touch on the competitive aspect of Schroders as a house to express these views.
Yeah. So let's just be clear on the goals, right? There's no point. You can invest anywhere. So Insignio can invest anywhere in the market. So there's no point us coming to you as a client and basically saying, I think this is a great idea. And then the asset class goes down over the next 3 years. And we can't even use the excuse. I've never used this as an excuse. Well, at least you didn't go down as much as the market. That doesn't add any value to you at all.
Sure.
The clear goal of the fund from here is to show decent appreciation well above the market in terms of its earnings growth potential over the next 1, 3, and 5 years. And that's how our clients scrutinize us on that basis. So some clients sold in 2020 because we went to 20% cash. A lot of those clients that sold in 2020 or the end of 2020, when we went to that high cash level, they're now buying back into the fund. And we were happily, when they say they want to pull out, we do not try and dissuade them and say, no, you've got to stay in. The fact we went at 20% cash tells you we were bearish on the sector. Yeah. So our goal of this portfolio, when we bring it to clients, is to make money over that 1, 3, and 5 year period. In terms of a difference between ourselves and BlackRock and Guinness in the portfolio, you'll see obviously our funds have performed nicely through cycle, but we stick to what we do. I mean, you sent me the Invesco Energy Transition Fund. It's got Home Depot, Walmart, Amazon. It's not an energy transition fund. It's basically a generalist fund. So we will stick to that exposure. We don't invest in lots of different thematic themes. We try and keep a core of thematic themes, and we try not to spread ourselves too thinly. So it's delivering that performance for the client is the first priority.
Great. We're coming up on our allocated time. Certainly not going to be the last time that we speak. Ladies and gentlemen, this is Mark Lacey, the PM for the Schroders Transition Energy Fund. If you've got any questions, please reach out. There's a depth of knowledge and research behind some of the topics that we touched on today. Mark, thank you so much for your time.
Thank you. Really appreciated.
Thank you, everybody. Merry Christmas.
Insignia Financial Group, LLC comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insignia International Financial Services, LLC, headquartered in Puerto Rico, and through Insignia Securities, LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insignia Advisory Services, LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insignia International Asesores de Inversión Uruguay, SA, Insignia Asesores de Inversión Latam, SRL, and Insignia Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insignia Argentina, SAU, and in Chile through Insignia Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insignia Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insignia.com/disclosures/ or via www.finra.org. To learn about Insignia Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Public Advisor Public Disclosures website, https://advisorinfo.sec.gov.